The Great Recession of 2008 to 2009, Causes and Responses by Jeremy Smith, the University of Global Campus, Business 626, Global Economic and Political Influence, with instructor Marlo Travaria, May 1st, 2021. The Great Recession of 2008 2009, Causes and Responses. As the economic advisor to Steve Forbes, I will present the cause and responses of the Great Recession here in the United States. The Great Recession culminated in financial follies made available by economic policies that allowed people to buy houses that simply could not afford them under a variable interest rate. This presentation will focus on the cause of the Great Recession based upon prior, current, and post-physical policies in place that contributed to the cause and response of the crash. Understanding these policies are essential to how the crisis has restructured the U.S. economy. Also, not only can the U.S. fall victim to another Great Recession, but it may be coming sooner than later, and it could be worse than the last crisis. I will propose different economic policies that could steer the economy away from another recession and/or depression in the future. Therefore, an analysis of the Great Recession indicates that physical policies were the primary cause and a crash is likely to happen again, but can be prevented with sound physical policies. The cause of the Great Recession and the resulting physical policies. The Great Recession resulted from shadow banking, scrutinization and derivatives, deregulation redux, and subprime lending. These policies created four factors that caused the Great Recession: a radical change in mortgage lending standards, prolonged interest rates, high banking to high banking debt to capital ratio, and high household debt to income ratio. The expansionary fiscal policy implemented by the government was the primary cause to a volatile housing market. The reasoning behind this policy was to promote housing ownership by forcing banks to loan out more money at lower interest rates. This led to the lowering of interest rates starting in mid 2007 by the federal government. The interest rates continued to fall through 2008 when the government noticed a giant bubble forming and needed to stabilize the market rates. Unfortunately, it was too late, and the government continued its expansionary policy by reducing the interest rates further. While the interest rates were on a fast track to the bottom, and the banks realized that they were holding a debt to capital ratio that was typically larger than the entire value of their companies. This was further exaggerated when the variable adjustment mortgage rates, ARMs, flipped to their higher rates, and the homeowners could not afford to pay the loans anymore because they were unable to buy the houses without enough capital or income. Therefore, all of these factors were a cause of the Great Depression of 2008 2009. The lasting effects of the recession on the economy. There are two primary facets that left long-lasting scars in the economy. The first is on the workforce, and the other is on policymakers. Firstly, in the workforce, where about 1% of the workforce continues to have wages diminished and their job skills degraded for years to come. This produces a long-lasting unemployment rate for years and even decades after the economic crisis of the magnitude of the Great Recession. There are long-lasting effects that are not necessarily positive at the leadership level for policymakers. These include nationalizing the mortgage rates, tax deductions, and ineffective regulations that set up the economy for another Great Recession in the housing market alone. Nationalizing the mortgage markets allow lenders such as Freddie and Fannie to access national coffers to support and encourage lending directly. Further, tax deductions are still in place that benefit those with higher wealth levels, inequality to the entire market, promoting continued housing and lending. Lastly, the ineffective regulations allow for free market to encourage selling houses and not even consider the effects if someone is even financially ready for the financial responsibility of homeownership. Therefore, these are the adverse effects that largely allow for the economy to just suffer from another housing or other great economic crisis. Could it happen again? Based upon the fast and loose regulations mentioned earlier, yes, the recession could happen again. Although the mortgage market has been primed for the greedy banks and Wall Street people to make the same nearsighted mistakes with a single misguided objective in mind, an economic crisis is looming on the horizon, might not necessarily seem which might not necessarily stem from a housing bubble. The next looming Great Recession is from an exaggerated policy to print money to support socialist agendas and policies, mainly in the form of handing out money in the form of stimulus checks, according to Mac in the provided video with Steve Forbes. This can cause economic crisis with staggering inflation, overprinting money, decreased purchasing power, increase in sustained unemployment, and decreased GDP production. Economic advice. Several policies can be taken now to stop and reverse the likely economic crisis looming in the near future. Firstly, I would like to recommend a contractionary fiscal policy that would include cutting additional unemployment benefits, creating taxes on the stimulus packages, and eliminating tax deductions from the stimulus packages. Secondly, I would like to make a new policy to prevent the current socialist programs from continuing fruition. Thirdly, I would like to create a tax cut policy where everyone pays taxes based upon their income. Fourthly, I would give a tax incentive to hire people. Fifthly, as increased taxes come in, I would put that money I would take that money out of the economy until the economy can stabilize. Sixthly, I would promote the production of buying USA products that are made in the US to help change the trade deficit with us and China to our advantage, where we are making money also by forcing China to buy from the US, or we will not be buying from China anymore. This would strengthen the economy and avoid another economic collapse because the M2 money supply would return back to manageable points, reduce spending, and encourage employment and production to increase GDP. Conclusion. The Great Depression was a prime example of an extraordinary expansionary fiscal policy coupled with banking, lending, and credit rating running unmanaged with a lack of policy or implementing bad policy. During the crisis, the expansionary fiscal policy continued until the contractionary policy was put in place. Unfortunately, the banking and investment sectors and policymakers still prefer to flirt with economic crisis by allowing the fundamental issues to continue. More so, there is another implementing economic crisis threatening the future of the economy with a massive amount of money that's being printed to fund socialist programs and stimulus packages that have not been fully explored to whether they're even making a positive effect. However, if we implemented a contractionary fiscal policy now, stop unnecessary spending, increase taxes, pull excess money out of the system, implement a flat tax, incentivize hiring, would also be a good place to start to prevent the next economic crisis. Thank you very much.